Hey everyone, and welcome to this explainer. Today, we're diving into something that literally impacts every single one of us every single day, and that's money. We're going to take all those complex, kind of intimidating financial concepts and just break them down into simple, actionable steps so you can actually start building a secure future.
I mean, seriously, why wasn't this taught in school? We all spent years analyzing classic literature, right? Memorizing the periodic table, yet we're just tossed into the real world without any sort of manual for taxes or credit scores? Well, today, we're finally handing you that playbook.
So, here's our quick roadmap for today. First, taking control of cash flow. Then, building your safety net. Navigating debt and credit. Saving, investing, and inflation. The power of compound interest. And finally, your next action step. All right, let's jump right in. Section 1, taking control of cash flow. Income versus expenses. You know the old saying, you can't manage what you don't track. And honestly, it is absolutely crucial here. Believe it or not, studies show that over half of adults don't actually have a firm grasp on their monthly spending. So whether you're using a fancy app or just a basic spreadsheet, you literally have to know exactly where your cash is going before you can start telling it where to go. This brings us to a real game changer. The 50-30-20 rule. It works like this. 50% of your income goes to your absolute needs, so things like rent and groceries. Then, 30% funds your wants. You know, dining out, hobbies, the fun stuff. And that final 20%, that is dedicated entirely to your future, meaning savings, investments, and debt reduction. Moving on to Section 2, building your safety net, and essentially surviving a crisis. I want you to keep this specific number in your head. 3 to 6. You really need 3 to 6 months of essential living expenses saved up in an account you can actually access easily. Because look, if your industry faces sudden layoffs, or say your car's transmission just completely blows out, which, by the way, is like an average $3,000 fix, having this financial runway turns what would be a total disaster into just a minor inconvenience.
And hey, we really can't talk about a safety net without mentioning insurance. Think of health, auto, and property insurance as your ultimate shields. They protect your financial house from those catastrophic, out-of-the-blue events that could otherwise completely wipe out a decade of progress literally overnight.
Okay, Section 3, navigating debt and credit. We like to call this the cleanup phase. So, there's this really massive misconception out there that all debt is inherently evil, but actually, there's good debt, which is money you borrow to build wealth or value over time, like a reasonable student loan or a mortgage. And then there's bad debt. That's the trap. That's when you're borrowing at, say, 20% interest just to buy depreciating assets like designer clothes. The goal? Leverage the good and ruthlessly eliminate the bad. When it comes to wiping out that bad debt, you've got two main strategies to choose from. First up is the avalanche method, where you attack the highest interest rate first. Mathematically, this absolutely saves you the most money. But on the flip side, there's the snowball method. This one ignores the interest rates and focuses on paying off the smallest balances first. It gives you this amazing psychological quick win to really keep you motivated. And then there's your credit score. This 3-digit number is basically your financial reputation. It literally tells lenders how trustworthy you are. I mean, a good score can determine whether you get approved for that apartment, and it heavily dictates the interest rate you're going to pay on a house. You really have to guard this number fiercely. Just pay your bills on time and keep your credit balances low. Which brings us to Section 4, saving, investing, and inflation. This is the growth phase. Let's talk about inflation. It's kind of this hidden enemy that just quietly steals your purchasing power over time. Think about it like this. If you stuff a $100 bill under your mattress today, historical inflation rates tell us that in a decade, it might only buy you like $70 worth of groceries. Letting your cash sit totally idle basically guarantees you're getting poorer every single year. Because of that, we absolutely have to separate the idea of saving from investing. Saving is for the short term. It's safe, it's perfect for those emergencies we talked about, but it definitely loses to inflation. Investing, on the other hand, like putting money in the stock market, yeah, it carries some short-term risk, but over the long haul, it is honestly the most reliable engine we have to actually beat inflation and build real long-term wealth. All right, Section 5, the power of compound interest. This is seriously your financial superpower. Compound interest is simply the concept of your money going out and making its own money. Check this out. If you start investing a steady amount at age 25, your final portfolio at retirement is going to be drastically larger than if you had invested the exact same monthly amount but started at age 35. Waiting just 10 years to start can literally cut your final retirement number in half. It's wild. Time is the secret ingredient here. The earlier you start, the more the math just steps in and does all the heavy lifting for you.
And finally, Section 6, your next action step. It's all about building momentum.
The biggest advice I can give you here is please don't try to implement the whole shebang all at once. Just pick one small step to start. Maybe track your spending for a single week, or take 10 minutes to open up a dedicated savings account, or even just take 5 minutes today to go check your credit score for free.
So, I'll leave you with this. What is one small step you are going to take this week? Don't wait for the new year. Don't wait for your next paycheck. Committing to just one tiny action today compounds over time, exactly like interest does. Thank you so much for joining me on this explainer, and I'll catch you next time.